Should you stay away from companies that pay a lower dividend when you have a loan against your cash value? I don't know. A lot of people are pretty adamant about it, but today we're going to do the math, so stick around.
Enjoy the episode.
Enjoy it more. If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we're going to be talking about the difference between direct and non-direct. And Anthony, is there a better choice between the two companies for infinite banking?
What I would say, originally, I thought there was.
Go ahead.
Did you as well?
I was told there was, yeah. I was told one was definitely better.
Yeah. But then, you know what, like one thing that we've done or is try to do is do the math, not just take what someone had told us. Let's really figure it out ourselves. And this is a common question that we get when somebody's looking at infinite banking. And I will say, I think the answer is going to surprise a lot of people.
Yeah. This is a question we get a lot, and it's also probably one of the topics that IBC advisors argue about the most.
Mm-hmm.
Right? So today we're going to lay it to rest. So stick around.
Yeah.
Anthony, tell us why this matters. Why is this important?
Well, this is important because this is how the insurance company applies dividends. So thus it might be different if you have a loan or not.
Mm-hmm.
So the importance is this is going to affect the cash value of your policy.
Yes, it will.
So, you know, you'd mentioned the direct and non-direct. Cameron, what the heck does that mean?
So mutual insurance companies, they have to make a distinction whether they're direct or non-direct. A direct recognition company is going to recognize a loan against your cash value. And what direct recognition companies do is they actually pay two different dividends. So they'll pay you one dividend, which is going to be the full dividend on any cash value that does not have a loan against it. And then they're going to pay you a lower dividend rate against any sort of cash value that does have a loan against it. So direct recognition, two dividend rates. A non-direct recognition company does not recognize that there are any loans against your cash value, and they pay everyone the same dividend. So they pay one dividend. Typically, when clients and advisors hear this, automatically everybody thinks, well, I think non-direct is probably the way to go.
Mm-hmm.
Right?
Yeah, and that's what, and you know, as we were studying, if you remember when I was tutoring you to pass the infinite banking practitioner exam, there's a big chapter on it.
There is.
But what was interesting, according to Nelson, there was no difference. And that's what he talked about in the training material. And also the policy that he used in his book, Becoming Your Own Banker, was a direct recognition company.
Yeah, great.
Meaning that they paid a different dividend for the amount that you have loaned out.
Yep. Anthony, so as we're going through this, is how does this apply to our listeners?
Well, I think what we really need, just like you said, at first glance, I want full dividends.
Yeah.
And the reason why I'm doing this is to take policy loans. So why would I want to risk having a lower dividend? We got to look at the math, and that's what we're about to do now.
Great. Let's go. Let's see what we got.
Here's what we did. Well, whenever an insurance company comes up with a new design on their product, we will always do a comparison. So what we have here is we're comparing 5 companies. The one in green, and I know if you're listening to this on the podcast, don't worry, I'll be able to explain it to you. But we have one company in green, Penn Mutual, which is a direct recognition company. And then we have 4 other companies, Mass Mutual, Lafayette Life, One America, and Security Mutual Life. Those are all non-direct recognition companies. And what we did in this example is we used a 44-year-old, and he's putting in $40,000 for 10 years. And of that, $12,000 is the base premium, or we like to call the want to premium. I'm sorry, the have to premium. And then the remaining 28,000 is a mixture of PUAs and potential term if we needed. But then after year 10, we drop the PUAs and are only funding the base premium. Now, we look at year 10, and again, this is with no loans. So we're not seeing the impact of it being a direct recognition. But if we look here, at year 10, Penn has $470,000. In second place is Lafayette Life with $436,000. So after 10 years, the direct recognition company has $45,000 more, and we projected it all the way to age 70. Penn is higher than all the other companies, and in second place is actually SML. However, Penn is higher by over $100,000 than the one in second place. The problem is this isn't a fair comparison with infinite banking. This would be great if you're just going to get the policy and never touch it. But if you're going to incorporate infinite banking, we need to see what the impact is of having those lower dividends. So what we did in the next scenario, what we did here, is this is with loans. And in essence, what we did is we did a max loan every single year.
Wow.
Okay. And then what we did is at age 70, we paid off the loan. That to me was the fairest way to truly get the impact of Penn being a direct recognition company. Now, even with loans, meaning this is with that lower dividend, Penn has 457, Lafayette still in second place, but they have $436,000. So Penn is still higher by $21,000. And we look at age 70, Penn has 1.2, SML still in second, and they have 1.1. So Penn is 65% higher. And so this is the impact with a direct recognition company with max loans every year, and they still have more cash value than the non-direct recognition companies. And Cameron, you know I love to do the one more.
Okay, that's one more.
Again, you know, each company's design has its own little quirks and advantages, and sometimes it can be really hard to match dollar for dollar. With Penn, from year 11 through 26, the other companies put in 12 grand a year. Penn just didn't have that capacity because the way that we designed it. They can only fund 10,300. So for 15 years, Penn had a lower premium. That total is $27,000.
Wow.
Okay, so we put $27,000 less in premiums, and we still have more money compared to the other companies. So Cam, I'm sure you need to take a second to collect yourself on how powerful the spreadsheet was. But as you're collecting yourself, love to know what are your thoughts?
Yeah, I wrote down two things here as you're describing the second scenario with the loans. You had max loans on here for 25 years.
Mm-hmm.
That's wild. That scenario is certainly an extreme. I don't know if I can think of a client that has max loans anywhere near that sort of duration. And so that's the first thing that kind of jumps out at me. And the second thing that jumps out at me is this is almost the exact opposite of what I was told. Right? So again, going through doing the math, we're actually finding out for ourselves that maybe not everything that was said is the truth. And so this is extremely valuable there. The next point that kind of comes to mind is that we do have some options if we are going to take loans against direct recognition companies, right, Anthony?
Mm-hmm.
Yeah. You want to highlight that?
Well, you know, one option we've talked about is, just to step back, if you're going to take a policy loan, insurance company uses your cash value as collateral, and we borrow from the investment arm of the insurance company. Now, we have the ability to change characters in the play. Instead of using an insurance company, there's special banks that will do the exact same thing, where they will use your cash value as collateral, but instead of borrowing from the insurance company, we borrow from a bank.
Mm-hmm.
This works very similar to a home equity line of credit or a HELOC. This is why we call this the LELOC, a life equity line of credit. And all we're doing is we're just using the bank to access the equity inside your policy. And so in theory, if you take a loan from a bank, that's not a policy loan.
Right.
So the eyes of the insurance company, there are no loans, and thus you will get the max dividend. Now, one downside of a LELOC is the interest rate is tied to the US prime rate. So right now the LELOC rates are on the high end, but things will settle down. And when they do, we do have that option of using the LELOC, where I know like one of your favorite shows was Hannah Montana. And so here you can get the best of both worlds, right? Where we can get that higher dividend and still be able to take policy loans.
Anthony, I'm going to make a comment here. I know what you're doing in this example, right? Is you had these, 5 companies where we came in and we approached it with the exact same premiums.
Mm-hmm.
The comment I want to make here is that that's not reality. Right. And so the way that we use these insurance companies is we don't typically approach them from a direct versus non-direct recognition company. Is I typically approach it from the design features that are available to us. So this example, as good as it is on a client level, right, I think there's a disconnect, because when we're trying to design a policy for a client, is there certain parameters that we're trying to design a policy specifically for that client? Some of those being, hey, maybe they want to do a kickstart, right? A kickstart is a single PUA in the first year that the insurance companies allow us to put in. And some companies, right, we can put in a larger kickstart or larger dollar amount than other companies. And so that is one of the driving factors that will allow us to choose or recommend a company for a client, among other things. There's several others, meaning catch-up provisions. I think you may have mentioned it before, but catch-up provisions, meaning where if you miss a year in PUAs, you can come back. Some insurance companies have a 1-year catch-up provision. Others have extended all the way out to 7 years. And so there are differences between the companies that we do want to consider when we're designing a policy as well. Do you wish you could finance all of your investments with your rewards credit card? Just imagine all the traveling that you could do with those miles.
Well, since they won't accept a credit card for a down payment on a rental property, you can do the next best thing, and you can finance your investments by using the infinite banking concept. And imagine all the traveling you could do with all that tax-free cash flow by just adding one extra step to your investing process.
You can learn more by scheduling a free 15-minute discovery call with Anthony or myself. The link will be in the show notes. And now back to the podcast.
In the prime example, I would tell you, we just pivoted. We had a client approved with Penn, and based on her funding, we ended up switching it over to Lafayette Life. And, you'd mentioned the Kickstart. As much as we like Penn's product, to be honest, they're terrible when it comes to Kickstart.
Yeah.
Right. And you can maybe do a small one, but you can't do a large one. And if you do a large one, then we need to do our special one and done policy. The problem is, really, for a one and done, you need to put a minimum of 75 grand in there. Not everybody has 75 grand.
Yeah.
And that was the case in this situation. Well, interesting enough, she had over 100 grand, but you know what? Again, we're just starting out, and she wasn't comfortable putting the whole amount in, which is no problem. But she ended up doing a $50,000 Kickstart, and that just wasn't conducive using Penn's product. So we pivoted to Lafayette. And then another example is we had a client. She's a young realtor where she's got some money now, but not sure how much money she's going to be making the next few years. Next few years are probably going to be a little tight, but maybe 3 or 4 or 5, she should start doing well. So we specifically went with Lafayette because that's one of the companies that has that 7-year catch-up provision, meaning she only needs to make that small premium during the next couple of years. But as she closes a house or sells an asset, she can go back and catch up back to 7 years of what she made. And to me, I think there's a couple things that I found in here, just like what you had said. Sometimes we were told things and it just was not so. That's why it's important to find out for yourself. And that's why we encourage our clients, don't just take our word for it. Go ahead and do your own research. But a couple of things that hit home for me is, for one, this shows how important your agent is.
Good point.
Right? Because just like you mentioned, Karen, maybe this policy looks better on a spreadsheet, but when we go in the real world, the way that they're going to fund it, they're not going to be able to fully maintain it. So we need to pivot in the right company that is best for the client. And I've said many times how much I'm not a big fan of dividends when it comes to insurance companies. This shows it pays a small impact on the overall performance. I would relate dividends on life insurance to like that movie trailer that you see that you're all hyped up and excited to see it. And then you finally get in and watch the movie and you're like, all the best parts were in the trailer. Right. And to me, these dividends are all sizzle, right? Very little stake. Because we didn't even go into the dividend rates, but there's 2 companies on here that pay a higher dividend rate than Penn. But Penn still beat them, so that just shows dividends are a super small piece. And really the biggest impact of your your policy is, for one, it's going to be that agent getting you in that right design, but even more importantly, how you use it.
Yeah.
Right. Because if you do infinite banking right, you should be able to build more wealth outside the policy than you do inside. And that's what's really going to determine your goals and your overall outcome.
We used to have a mentor that would say, give me a crappy policy and let me use it for infinite banking, and I'll outperform your good policy. And what he meant by that was, there's policies out there that maybe they weren't originally designed, right, for infinite banking, whether it's direct versus non-direct, or whether it's the ratio between base and PUA. And then he'd say, put that up against somebody that has, the best policy with the best company, quote unquote, that's out there. Again, to reiterate this, it's more about what the client's going to be doing with the policy than what the insurance company's doing with the dividends and or cash value increases over the years.
Well said, Cam. So what should somebody's next step be?
Yeah, guys, if you're out there and you're listening to this and you're like, man, I'm not sure, direct, non-direct, what I would end this podcast with is, man, you know what? It doesn't matter. The way that you should approach a policy, or maybe your first policy, is just, we'll find something that's a good fit for you now based upon the contributions that you want to make. It may be direct, it may be non-direct. Secondary to that, what I would tell you is, most of the time clients are going to be adding on multiple policies over the years. And so it is prudent a measure to start to bring in, or if you start with a direct recognition company, maybe consider a non-direct for your second policy. And as you look back over the next 10 years or so, maybe you've got 4 or 5 policies and half of them are direct and half of them are non-direct. Outside of that, guys, if you have questions, feel free to reach out to us. If you've got a policy you're not sure which is which, but you'd like some more details on it, feel free to reach out. We'd be happy to go through that with you.
Go make it a fantastic day.
Take care.
If you like this video, I know you'll like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.